Have you ever wondered why millions of Americans work hard their entire lives yet remain stuck in place while a small minority quietly build financial freedom starting from a very modest figure? Today, we are not talking about a $1 million dream or how to become a billionaire. We are focusing on a realistic number often dismissed on Wall Street, yet arguably the most decisive figure in your personal investment journey, $20,000. According to the Wyckoff method, the framework that many of the world's most sophisticated investors use to read market behavior, $20,000, represents the preliminary support of your life. It is the point where a downward trend stops. It is the beginning of accumulation. It is the seed for every future growth phase. Let us explore why this seemingly modest number carries the weight of a mountain and how you can transform it into a launch pad for genuine financial freedom. Ladies and gentlemen, let us set aside the dream of becoming a billionaire. Today, we will concentrate on a very specific and practical figure, $20,000. This is not $1 million or $10 million levels many people imagine when they think about investing. On Wall Street, if you mention $20,000, someone might smirk because for them it may only cover a fine bottle of wine at dinner. However, if you ask seasoned investors such as Charlie Munger, or if you analyze it through the lens of the Wyckoff method, the conclusion is clear. $20,000 is the most important sum, the hardest to accumulate, and the most decisive threshold in your personal financial journey. The Wyckoff method, developed by Richard Wyckoff in the early 20th century, teaches that markets never move randomly. All price fluctuations in stocks or other assets can be interpreted as the behavior of a single dominant entity known as the composite man. This concept represents smart money flowing from large institutions, investment funds, and professional operators. The composite man is not a specific individual. It is a metaphor for coordinated, calculated behavior. Smart money accumulates quietly. It influences crowd psychology in order to buy at low prices. Then it advances prices higher once positions are fully built. Applied to personal finance, your journey resembles a small market governed by your own internal composite man, meaning you who must battle forces such as financial scarcity, rising living costs, debt obligations, and consumer culture in this United States. In the early stage, you are effectively in a markdown phase where every attempt to save is pulled backward by unexpected expenses and life pressures. The figure of $20,000 functions as the critical mass required to exit this personal financial markdown phase. It corresponds to Phase A in the Wyckoff accumulation structure. Under Wyckoff principles, Phase A begins with preliminary support. This is the point where significant buying interest emerges to halt a prolonged selling wave. In personal terms, $20,000 is your preliminary support. It does not make you visibly wealthy. Instead, it provides a capital base strong enough to prevent financial liquidation behaviors such as high-interest borrowing or emotional spending. Wall Street may dismiss this amount, but in Wyckoff logic, this is precisely where your personal downtrend ends and the construction of a trading range begins. The purpose of this analysis is not to promote rapid wealth through high-risk tactics. Instead, we examine how to accumulate systematically in the true Wyckoff sense in order to build sufficient cause that will naturally lead to the markup phase. When you establish a strong cause from $20,000, the rest becomes a domino effect. Capital begins working for you. Compounding interest activates. Wealth grows at an exponential rate. This mirrors how the composite man transforms a quiet accumulation position into a powerful markup that the public only recognizes when it is already too late. This is the logical beginning of an escape from financial gravity, the condition where most people remain trapped. From here, Phase A transitions into Phase B, where psychological and structural causes are built deliberately and strategically, preparing the foundation for sustainable long-term expansion. Phase A, stopping the downtrend. The gravity well of financial fragility. From zero to approximately $20,000. We now examine Phase A under the Wyckoff method. This is the stage where the markdown phase of personal finance comes to a halt. In the stock market, Phase A is when the composite man begins to establish preliminary support in order to stop a prolonged wave of liquidation. In your personal journey, this corresponds to the period from zero to roughly $20,000. It is the zone where life becomes extremely fragile, vulnerable to any external shock. Visualize it clearly. When your bank account fluctuates around a few $1,000s or is slightly negative due to credit card debt, everything becomes unstable. Nassim Taleb has written about anti-fragility, the capacity not only to endure shocks but to become stronger because of them. In this stage, you are on the opposite side. You are fragile to the point that a minor disruption can push you into a financial abyss. This is not exaggeration. It is the daily reality of millions of Americans. Consider a typical sequence of events that anyone living paycheck to paycheck immediately recognizes. Your car breaks down. The repair bill is $500. For you, this is not just an expense. It may mean you cannot pay rent this month. To cope, you turn to a payday loan with extremely high annual interest rates, often 300 to 400% per year. Once trapped, the debt spiral begins. You pay interest this month, then borrow again the next month. Or you develop a toothache. Without funds for a dentist, you endure the pain. 1 year later, a minor issue becomes a severe infection requiring surgery. The cost escalates from a few $100s to several thousand. This is the cruel paradox of poverty. Without reserve capital, the cost of survival becomes far higher than it is for those with financial resources. Banks charge maintenance fees for low balances. Landlords impose late penalties. You purchase inexpensive shoes every year instead of investing in a durable pair that lasts 5 to 7 years. These small expenses accumulate into a powerful drag that keeps you pinned at the bottom. This condition can be described as a financial gravity well, a concept inspired by physics. A rocket must burn most of its fuel in the first minutes to escape Earth's gravitational pull. In the same way, you must surpass a minimum capital threshold to escape this loop. Small savings efforts are pulled backward. It is like walking in quicksand. You lift one foot and the other sinks deeper. Charlie Munger famously stated that the first $100,000 is extremely difficult. That statement was made decades ago when living costs were significantly lower. In the economic environment of the United States in 2025 and 2026, with cumulative inflation, rising urban rents, and sharply increasing medical and education costs, the practical psychological threshold for most ordinary workers has shifted downward to around $20,000. This figure is not arbitrary. It is the level at which you begin to have sufficient cushioning to avoid being pulled into debt every time a minor disruption occurs. Why does investing fail so dramatically at this stage? Because the principal is too small. Compounding cannot meaningfully activate. Suppose you are a highly skilled investor capable of achieving a 100% annual return, a rare outcome. With $1,000, you earn an additional $1,000, bringing the total to $2,000. That sounds impressive. In reality, the amount does not meaningfully change your structural condition. The gain is immediately absorbed by rent, utilities, transportation, and daily expenses. No structural transformation occurs. Anxiety about next month remains. The psychological consequences of being trapped in this gravity well are severe. Many young Americans become discouraged after several years of struggle. They begin to believe that social mobility is dead, that hard work is futile because the system does not allow upward movement. In response, they anesthetize the pain through consumption. Online shopping, dining out, short trips financed with credit cards. This behavior is consumption as escapism, a form of financial self-sabotage encouraged by the broader consumer culture, composite man. The conclusion of Phase A is direct. This is where most retail investors are defeated by the composite man of consumer culture in the United States. It is a system structured to keep individuals in continuous debt, spending beyond capacity and never reaching critical capital mass. However, if you recognize your position and commit to building preliminary support by prioritizing accumulation over consumption, you have already begun to exit the downtrend. Phase A is not the place to generate large profits. It is the place to stop the fall and establish a stable foundation for what comes next. The next step is the transition from Phase A to Phase B, where you begin constructing genuine cause, both psychological and financial, in preparation for a sustainable breakout. And then, after sustained discipline and persistence, you reach the milestone of $20,000 in your account. This is not the moment you suddenly become wealthy in the Hollywood sense. There is no Ferrari parked outside. There is no new mansion. Outwardly, you look exactly the same as yesterday. But internally, a decisive shift has occurred. This is the launch point. The moment you surpass critical mass, escape the financial gravity well, and formally enter true accumulation under the Wyckoff framework. Return to the physics analogy we have used from the beginning. When a rocket reaches escape velocity, the air becomes thinner. Drag decreases sharply. Earth's gravitational pull weakens. The rocket no longer burns enormous fuel simply to avoid falling back. Everything becomes easier. Not because the world has changed, but because the rocket has changed its position within the reference frame. The same is true for you. In the Wyckoff structure, this is where Phase A concludes. Preliminary support has been firmly established. The downtrend is broken. Your personal financial market enters a trading range. This is a period of sideways consolidation where the composite man, now represented by you, begins accumulating additional position size without attracting dramatic attention. There are no longer sudden collapses triggered by minor accidents or unexpected expenses. Instead, you operate from a stable base that allows systematic accumulation. The most important transformation here is internal, not cosmetic. You are not yet a millionaire, but you are no longer living paycheck to paycheck. With $20,000, you possess a genuine financial buffer. In many cases, this represents 6 to 12 months of living expenses, depending on your cost structure and location, whether that is New York, San Francisco, or a smaller town. For the first time, you feel that money no longer fully controls you. You are on the launch pad. The countdown has begun. Consider this from the perspective of a disciplined American investor. In the earlier stage, you resembled a stock in a markdown phase. Price declined continuously as supply overwhelmed demand. Panic selling dominated. Now you have reached a point where demand, meaning your financial resilience, begins to exceed supply, meaning living cost pressure. This is the first genuine sign of strength in your personal trajectory. Your internal composite man, defined by reason, discipline, and long-term vision, has regained control from the emotional crowd, including fear of job loss, consumption pressure, and fear of missing out. The real transformation is not that $20,000 instantly generates extraordinary returns. The transformation lies in your perception of risk and opportunity. Previously, a small mistake could destroy your entire plan. Now you have breathing room. You can test ideas. You can wait patiently. This is the foundation of Phase B, where you begin constructing a stronger cause. In the economic environment of the United States in 2026, with interest rates remaining relatively elevated and living expenses continuing to rise, accumulating $20,000 in savings is a meaningful achievement for most working individuals. It is not merely capital. It is evidence that you have begun to win against a system structurally oriented toward perpetual consumption. When you recognize this, confidence begins to emerge. You are no longer a passive victim of circumstances. You are becoming the primary operator of your own personal financial market. This launch point represents a turning point. From here, the journey shifts from fighting for survival to building for growth. The next stage is Phase B, where psychological and financial cause are deliberately constructed, and where the power to say no, along with a refined shift in perception, becomes your most effective strategic asset. After you move beyond the launch point and establish preliminary support at the level of $20,000, you formally enter Phase B. This is the cause-building stage under the Wyckoff method. In the stock market, Phase B is the longest and most silent portion of the accumulation structure. The composite man, meaning smart money, continues to buy gradually within a sideways trading range. There is no dramatic breakout. There is no sensational news. There is only patient preparation. The objective is to accumulate sufficient volume to generate a cause strong enough to support a sustained markup later. Applied to personal finance, Phase B is the stage where $20,000 begins to demonstrate its real power. Not through immediate investment profits, but through a profound psychological shift. This is where you construct internal cause. You build a stable mental foundation for long-term expansion. The most important cause created by this capital base is the emergence of refusal power. This is the ability to say no without fearing financial consequences. Consider a simple but realistic comparison that many office workers in the United States can easily imagine. Two young professionals, Jack and Mike, work at the same company. They earn similar salaries and possess comparable skills. The only difference is financial position. Jack has no savings and carries approximately $1,000 in credit card debt. Mike has accumulated $20,000 in cash sufficient to cover 6 to 12 months of living expenses without income. One day their manager enters the room and makes an unreasonable demand. Work unpaid overtime on weekends or promote a product they both know is flawed. How does Jack respond? His heart rate accelerates. Cortisol, the stress hormone, surges. His brain shifts immediately into survival mode. If I refuse, I may lose my job. If I lose my job, how will I pay rent next week? What about my car payment? Fear overrides rational analysis. Even if he disagrees internally, Jack lowers his head and complies. In that moment, he is not negotiating from strength. He is reacting from financial fragility. Mike responds differently. With $20,000 in reserve, no internal alarm is triggered. He evaluates the situation calmly. He can look at his manager and say, "I do not believe this approach is appropriate. Can we consider an alternative?" If the demand crosses ethical boundaries, he can even think, "If I leave this position today, I will still be stable." Mike may not resign, but because he has the option to walk away, he holds leverage in every negotiation. This reflects a core Wyckoff principle applied to life. If you cannot walk away, you cannot negotiate effectively. $20,000 is not merely capital. It functions as protective armor for your character. It grants you the power to refuse unreasonable authority, unnecessary consumption, or unethical pressure without descending into desperation. Behavioral science supports this shift. In the book Scarcity by Sendil Mullainathan and Eldar Shafir, research indicates that financial strain can temporarily reduce measured cognitive performance by approximately 13 to 14 points, an impairment comparable to severe sleep deprivation. When you constantly worry about money, cognitive bandwidth becomes consumed by survival concerns. The result is short-term decision-making, purchasing lottery tickets in hope of escape, accepting extremely high-interest loans, spending hours to save small amounts while ignoring long-term strategy. The issue is not intelligence. It is limited mental capacity under pressure. When you hold $20,000 in reserve, cognitive bandwidth begins to recover. You are no longer preoccupied with next week's bill or sudden job loss. Your brain transitions from survival mode to strategic mode. You begin thinking in quarters and years rather than days. At work, you focus on intelligent execution rather than frantic effort. In social settings, confidence increases. Emotional stability improves. This transformation does not come from motivational content. It emerges because the internal survival alarm has finally been silenced. Through the Wyckoff lens, this is a deeper definition of wealth. Wealth is not yachts or mansions. It is the ability to wake up and state, "Today I choose what I will do." $20,000 is the entry ticket to that freedom. It does not purchase luxury assets. It restores your most valuable assets, your rational judgment and your dignity. You may still drive a car that is 10 or 15 years old. Your shoes may show wear, yet you are financially stronger than someone driving a luxury vehicle financed by a large auto loan while living under constant monthly repayment stress. You are no longer walking a tightrope. You now stand above a safety net. In Wyckoff terminology, you have established a last point of support beneath your position. Only when fear of falling disappears can you execute complex strategic decisions. Phase B is quiet but critical. You are accumulating more than money. You are accumulating internal strength. The composite man within you continues to build position gradually. Confidence increases. Patience increases. Refusal power increases. When cause becomes sufficient, the markup phase emerges naturally. The next step is phase C. This is where the mathematics of compounding activates in a meaningful way. At that point, you will clearly see why $20,000 represents the true critical mass required for compound growth to function effectively. After establishing a strong psychological foundation in Phase B, you enter Phase C, the final test under the Wyckoff method. In a classical accumulation chart, Phase C often appears as a spring or a shakeout. Price declines sharply in order to test whether supply has truly been exhausted. At the same time, weak hands and impatient participants are forced out. This is the moment when the composite man conducts a final test before initiating a sustained markup. Applied to personal finance, Phase C becomes a decisive mathematical examination. The question is simple. Will the compounding engine truly activate? The answer depends entirely on whether you have reached critical mass, defined here as $20,000. Without this mass, every prior investment effort resembles attempting to ignite a nuclear reactor with insufficient uranium. No sustained reaction occurs. Only a brief release of heat followed by extinction. Consider a direct and realistic comparison familiar to many investors in the United States. Assume you are an exceptional investor capable of generating an average annual return of 10%, a level that exceeds the performance of many professional funds. If your capital base is $1,000 and you earn 10%, you generate $100 in profit over a full year of research and disciplined execution. $100 sounds respectable. In practical terms, it changes nothing. It may cover a single quality dinner or a few tanks of fuel. Then it disappears into rent, utilities, or minor repairs. The return is absorbed by the background noise of daily life. No structural shift occurs. You remain in the paycheck-to-paycheck cycle. Now consider the same 10% return applied to $20,000. The annual profit becomes $2,000. For many middle-class households in the United States, $2,000 represents 1 month of income or 2 months of rent. This is no longer a difference of scale. It is a difference of nature. When passive investment income can meaningfully cover a major expense such as rent, an auto loan payment, or a substantial contribution to an emergency reserve, you recognize that you are no longer operating alone. Capital has become your partner. It does not sleep. It does not consume. It does not require emotion. Yet each year, it reliably produces additional margin of freedom. Warren Buffett has often described life as a snowball rolling downhill. The critical factor is not the quantity of snowfall, but finding wet snow and a long slope. $20,000 functions as your first compact core of wet snow. Without that core, loose snow will scatter and never consolidate. Once the core forms, gravitational forces begin to assist rather than resist. Previously, gravity pulled you downward. Now it accelerates your expansion. To illustrate the power of compounding at this stage, consider the rule of 72. Divide 72 by the annual rate of return and you approximate the number of years required for capital to double. If $20,000 is invested in a broad-based, low-cost index fund tracking the United States equity market, such as a fund following the Standard & Poor's 500 index, and if we assume a long-term average return of 7 to 10% annually after inflation and expenses, then the capital doubles approximately every 7 to 10 years, provided it remains invested. The progression becomes clear. $20,000 becomes $40,000. $40,000 becomes $80,000. $80,000 becomes $160,000. $160,000 becomes $320,000. $320,000 becomes $640,000. This process can unfold passively. No additional capital contributions are required. No speculative stock selection is necessary. You simply allow the capital to compound along the long-term expansion of the United States economy. By retirement age, what began as a modest figure can evolve into substantial financial support for a comfortable standard of living. However, before focusing on return percentages, internalize an essential warning. Before reaching $20,000, do not concentrate on achieving 10% or 20% returns. Many young investors with only a few $1,000s become fascinated by options contracts, digital assets, or highly speculative equities promising tenfold gains. They reason that small capital makes moderate returns irrelevant, so they pursue extreme upside. This is mathematically self-destructive logic. By dismissing stable returns, they accept the risk of total capital loss. When principal declines to zero, the process resets. You return to the starting line, having lost time and opportunity. The objective in Phase C is clear: defend and accumulate. Enter what may be called a disciplined gathering mode. Exchange labor and time for capital. Live efficiently. Compress and solidify your initial core of wet snow. This is a physical process. There is no secret formula. Once the core stabilizes, a fundamental shift occurs. You transition from human-powered income, where you work for money, to capital-powered income, where money works for you. Below the threshold of $20,000, you remain subordinate to capital. Above this threshold, capital becomes your employee. At first, it may appear modest in productivity. Over time, its growth rate exceeds your expectations. Phase C confirms readiness. No further shakeout can destabilize you because supply, meaning financial pressure, has largely been absorbed. From this point, the compounding engine rotates with genuine force. The journey advances into Phase D, where clear signs of strength emerge. The next stage, Phase D, represents the great filter and the discipline required to avoid falling back into the gravity well. After you have built a solid cause in Phase B and passed the compounding ignition test in Phase C, your personal financial journey enters Phase D. This is the stage where clear signs of strength and the last point of support begin to appear. In the Wyckoff structure, this is the moment when the composite man has accumulated sufficient volume. Selling pressure has been largely exhausted and the market prepares for a breakout, meaning a strong and sustainable advance. Price no longer moves randomly within a range. It begins to display genuine strength through shallow pullbacks that recover quickly, accompanied by gradually expanding trading volume. In personal finance, Phase D is when you clearly feel the shift. Your account is no longer threatened by minor shocks. Compounding begins to generate meaningful passive income. You experience a real sense of control. This is the preparation stage for the markup phase where assets expand with momentum. Yet this stage contains the greatest danger of all. It may be described as the great filter inspired by the Fermi paradox in cosmology. The Fermi paradox asks a simple question. If the universe is vast and contains billions of potentially habitable planets, why have we not observed evidence of other advanced civilizations? One proposed explanation is the great filter, an extremely difficult evolutionary barrier that most life forms fail to cross before achieving interstellar capability. In wealth accumulation, $20,000 functions as such a filter. Real-world statistics suggest that many ordinary Americans reach this level of savings at least once, sometimes multiple times during their lives, yet most eventually return to zero. The reason is not mathematical, it is psychological. They fail the test embedded in Phase D. The greatest danger is the reward trap. After 3 to 5 years of disciplined living, declining luxuries, postponing purchases, and saving aggressively, you finally hold $20,000. At that moment, the brain activates a compensation mechanism. You have worked hard. You deserve a reward. Then your 10-year-old car breaks down again. You walk past a showroom and see a new sport utility vehicle. The required down payment is exactly $20,000. An internal voice whispers that you have earned it. This is where most people fall. They sign the check. They drive home in the new vehicle feeling successful. From a Wyckoff perspective, this is the moment they eliminate their newly formed golden asset. The vehicle is not an appreciating asset. It is a depreciating liability. The moment it leaves the dealership, it may lose 20 to 25% of its value. More importantly, the compounding core you built is destroyed. Not only are you back at the starting point, you now carry an auto loan, higher insurance premiums, increased fuel expenses, and maintenance costs. The financial gravity well reopens and pulls you downward again, often more forcefully because you have tasted the illusion of success. Beyond internal temptation, there are external pressures. One example is the crab bucket effect. If a single crab is placed in a bucket, it may escape. If several crabs are placed together, each time one attempts to climb out, the others pull it back down. When you begin declining unnecessary consumption, when you discuss investment strategy instead of idle talk, friends, colleagues, and even relatives may react negatively. They may say that money is meant to be spent. They may mock your older car. The reaction is not necessarily malicious. Your discipline highlights their indulgence. Subconsciously, they may resist your progress because it implies entry into a world they have not chosen to pursue. To pass this great filter, you must accept appearing slightly unconventional by mainstream standards. Learn to enjoy watching the account balance increase rather than expanding a wardrobe of luxury brands. When the urge to spend intensifies, remind yourself that this capital is not a reward for past sacrifice. It is seed capital for future freedom. If you consume the seed immediately, there will never be a harvest. This is the most demanding test on the path to wealth. It is not a test of earning capacity. It is a test of perceived worthiness. Do you believe you deserve long-term financial independence or only short-term pleasure? If you resist the new vehicle, purchase the expensive credit-financed vacation and the downward pull of social pressure, you have crossed the great filter. You join the small minority who not only reach $20,000 but preserve it. At this point, the $20,000 remains intact. It has not been converted into a depreciating asset. You now display clear signs of strength. The account is stable. Compounding is active. Psychological discipline is firm. This is the last point of support before breakout. The composite man within you is prepared. The markup phase approaches. The next stage is Phase E. This is where tactical execution begins, moving from $20,000 toward $100,000 with structured capital allocation and the avoidance of critical financial pitfalls. When you have passed the great filter in Phase D, preserved $20,000, and demonstrated clear signs of strength, your personal financial journey officially enters Phase E, the stage where markup begins. In the Wyckoff method, Phase E is when the uptrend is confirmed and accelerates. Price breaks out of the accumulation range. Trading volume expands. The composite man intensifies his effort, converting accumulated cause into visible growth. Sideways fluctuation ends. Momentum becomes the dominant trend. Late participants can only follow at higher risk. In your personal journey, Phase E is the stage of tactical execution. The objective is clear move from $20,000 to $100,000, a milestone that Charlie Munger once described as far easier than earning the first $100,000. Why is it easier? Because you now operate with two parallel engines. The first is passive compound interest generated by existing capital. The second is active income driven by increasing your personal value. The markup phase is not a time for gambling. It is a time for discipline, intelligent capital allocation, and strategic use of time. The tactical blueprint appears simple, even boring. Do not chase hot stocks. Do not speculate on explosive trends. If you deploy $20,000 to pursue a moonshot that promises a tenfold return, you effectively remove yourself from the game. Instead, position yourself as a long-term investor, similar to how the composite man operates. Accumulate systematically. Hold your position. Allow the market to perform the heavy lifting. Capital allocation is the most important decision in this stage. Divide the $20,000 into two clearly defined components. The first component, $5,000 to $10,000, is your bulletproof vest. This capital must remain untouched. Place it in a high-yield savings account or in short-term United States Treasury bills. The objective is not high return. The objective is psychological stability and protection against life's volatility. When a car breaks down, when illness strikes, or when employment is interrupted, this reserve absorbs the shock. It prevents you from liquidating investments at market bottoms. Many American investors suffer severe losses not because markets collapse, but because they lack defensive capital. When markets decline 30%, they require immediate liquidity and are forced to sell at the worst possible moment. That is the most avoidable form of destruction in financial markets. The second component, $10,000 to $15,000, represents your soldiers. For most individual investors without privileged information or advanced analytical skill, the most effective strategy is simple. Do not search for a needle in a haystack. Purchase the entire haystack. Select low-cost index funds that track broad market performance, such as funds that follow the S&P 500 index or the total United States stock market. You do not need to master candlestick charts. You do not need to follow speculative headlines. Deploy your capital to capture the long-term growth of the largest economy in the world. Historically, the United States equity market has delivered average annual real returns of approximately 7 to 10% over more than a century. That is sufficient for compound interest to operate effectively. However, passive compounding from $10,000 to $15,000 alone will build wealth slowly. You require acceleration. This is where asymmetric risk becomes relevant. Asymmetric risk means that potential upside significantly exceeds potential downside. When you have no capital, every risk is existential. With a $20,000 cushion, you can engage in opportunities where maximum loss is limited, while potential gain is substantial. The most powerful example is investment in human capital. Allocate $1,000 or less toward professional certification, online education, or acquisition of high-income skills, such as software development, digital marketing, or sales. If the effort fails, you lose a defined amount of money and time. The downside is capped. If it succeeds and increases your monthly income by $500, that equates to $6,000 per year, or $60,000 over a decade. In regulated financial markets, few lawful investments produce comparable returns. This is the leverage of human capital. The $20,000 buffer allows experimentation without fear of financial collapse. This cushion also enables exploration of secondary income streams, including entrepreneurial ventures or structured side businesses. The distinction between persistent poverty and middle-class stability in the United States often lies in the presence or absence of a financial buffer. Without it, individuals sell labor continuously at low margins. With it, you can use capital to enhance future earning power. Two engines now operate simultaneously. Passive market returns, though modest, continue compounding. Active income rises as your skills improve. Combined, they accelerate growth far beyond the phase from $0 to $20,000. There are, however, three immediate hazards in Phase E that can reset your progress to zero. First, avoid leverage. Do not borrow on margin. Do not incur debt for speculative investment simply because you possess $20,000. Financial institutions may offer credit enthusiastically. Decline it. Leverage eliminates your time advantage. Minor market fluctuations can trigger forced liquidation known as a margin call, erasing capital rapidly. Second, avoid complex derivatives. Options, contracts, futures contracts, and high-frequency trading systems are domains dominated by professionals with structural advantages. Entering without expertise places you at a severe disadvantage. Instruments that promise rapid short-term profit frequently conceal asymmetric loss. Third, do not purchase a primary residence at this stage. $20,000 is typically insufficient for a stable down payment. Entering a mortgage obligation prematurely restricts liquidity and reduces strategic flexibility. The financial freedom you recently secured can disappear under fixed monthly obligations and psychological pressure to maintain employment stability at any cost. Patience remains essential. $100,000 is the next strategic threshold. At that level, compound interest becomes audibly powerful. You are no longer pushing a snowball. You are initiating an avalanche. Phase E represents the transition from accumulation to genuine expansion. Maintain your defensive reserve. Deploy your investment soldiers. Continuously enhance your human capital. The markup phase is underway, and you now operate with structural advantage. The final stage will redefine wealth itself, focusing on the true dividend that $20,000 ultimately delivers to your quality of life. We have completed the journey through the Wyckoff method. From the financial gravity well of Phase A, where every effort is pulled backward through the launch point and the construction of psychological cause in Phase B, to igniting the engine of compound interest in Phase C, crossing the grate, filter in Phase D, and executing markup strategy in Phase E. Now we pause and examine the entire structure. It is time to redefine wealth not in the way it is commonly marketed in American culture. True wealth is not net worth on a balance sheet. It is not a seven-figure brokerage account. It is not the quantity of physical assets you possess. Wealth is the quality of life you experience each day. When you reach and preserve $20,000, you begin receiving an invisible dividend that exceeds the nominal amount itself. It is a low cortisol life. Cortisol is the primary stress hormone. When chronically elevated due to continuous financial anxiety, it gradually harms the body. It disrupts sleep. It increases irritability. It weakens immune response. It contributes to long-term health complications. Poverty is not only a shortage of money, it is a chronic physiological condition. When $20,000 functions as your financial armor, even without luxury consumption, cortisol levels decline, sleep improves, patience increases, conflict within the household decreases. These incremental improvements compound into stronger health, more stable relationships, and clearer cognition. No luxury watch or premium vehicle can purchase those outcomes. This invisible dividend exceeds the face value of $20,000. It removes suffering. It reduces midnight anxiety about rent. It softens fear of unexpected job loss. It provides resilience against medical expense shock. Money does not purchase happiness directly. It can, however, remove significant pain. The first $20,000 is often the most powerful treatment for that specific category of pain. The core philosophy here is a reversal of power. Before reaching $20,000, money is your master. You submit to it. You accept undesirable employment. You tolerate poor management. You exchange time and health for survival income. After $20,000, the relationship inverts. You become the operator. Money becomes the instrument. If you save merely to spend recklessly later, you will never become truly wealthy. You will be temporarily liquid but structurally fragile. If you save to reclaim control over your time, to say no to what does not align with your values, to choose how you spend your day, then even with $20,000 you are wealthy in the most meaningful sense. Let us restate the full progression. From the dark gravity well of fragility in Phase A, through the psychological shift that grants refusal power and internal autonomy in Phase B, to the mathematical ignition of compound interest at critical mass in Phase C, across the great filter to avoid regression in Phase D, and into disciplined execution preparing for sustained markup in Phase E. All of that structural transformation rests upon what appears to be a modest figure, $20,000. It sounds small. Within the logic of the Wyckoff framework, it carries enormous structural weight. It is your preliminary support. It is the first dense core of snow before an avalanche. It is the seed from which the entire markup phase grows. If you have not yet reached this threshold, do not become discouraged. Ignore performative displays of wealth across social media platforms. Those signals are noise. Focus on your own incremental positioning. This analysis is not intended as passive entertainment. It is a practical challenge. Define your current position clearly. Identify what you are prepared to sacrifice in order to accumulate $20,000. It may be discretionary consumption. It may be lifestyle upgrades. It may be additional weekend work. Write it down as a commitment to your future self. When that day arrives, whether in 3 years or 5, when you have both reached and preserved $20,000, revisit this reflection and confirm your achievement. At that moment, you will recognize the true shift. You did not merely increase a savings balance. You altered the trajectory of your family's financial future. The game is underway. Accumulate your first strategic position. Allow the composite man within you to direct the markup phase with discipline and clarity. I wish you success.